Hello, everybody. We're just going to give it a minute for people to come in and get a proverbial seat. We are going to try to start at 1:01. So if you need to grab your lunch or whatever, you have a minute to do it. 60 seconds. Go. Watching my clock. Should have done like a countdown timer. That'd be fun. Okay, we have hit 1:01 and we've got a lot to cover, so I'm going to get started. So good afternoon, everybody. Welcome. Thank you for coming. I am Shannon Watson, former Chamber employee and current Executive Director of Majority in the Middle. Thank you for joining us for Navigating Impacts to Tax Policy, the One Big Beautiful Bill Act, also known as HR 1 or OB3 or OBBBA. The thing has a lot of names. So today we are connecting business and nonprofit leaders with insights on the changes this legislation brings and what it means for planning and decision making. A few housekeeping items as we get started. The webinar is being recorded. All attendees are muted with cameras off, and we encourage you to submit your questions in the chat. We are going to do our best to get to as many as possible during the Q&A at the end. We are already asking for superhuman effort from our panelists and just giving them 15 minutes each for very complicated topics. So they won't be able to cover everything, and we're going to try to get to as many questions as we can. Like I mentioned, the meeting is being recorded. It will be shared in a hidden link that will be shared just with the registered participants. So it'll be out on YouTube, but it won't be, broadcast to the world. So before I dive in, I want to thank our co-hosts, the St. Paul Area Chamber, the Minneapolis Regional Chamber, and the partner organizations who helped make this webinar possible, including the Better Business Bureau, East Side Area Business Association, Midway Chamber of Commerce, Oakdale Area Chamber of Commerce, and the Shakopee Chamber of Commerce. I also want to thank the government affairs sponsors who make these events possible. We'd like to recognize Associated Bank, Comcast, Delwood Gardens Assisted Living, District Energy, Ecolab, Evergreen Energy, KSTP TV, McGough, Morrissey Hospitality, Minnesota United, MPR, Pack Properties, St. Paul Saints, Scanlon Group, Securian Financial, TKDA, US Bank, WSB, and Excel Energy. Wow, that's a great list. Today, our panelists will walk us through the core of the bill, key tax provisions, immediate impacts, and practical takeaways for your next steps. So please join me in welcoming our panelists, Marie Ellis, the Minnesota Council of Nonprofits, Adam Gehring from Baker Tilly, and John Kirchner from the U.S. Chamber of Commerce. We are going to begin with John. John serves as the U.S. Chamber's Executive Director for the Upper Midwest region, representing the states of Iowa, Minnesota, Nebraska, North Dakota, South Dakota, and Wisconsin. He works closely with local chambers, business leaders, and members of Congress to advance the chamber's national priorities. John, thanks so much for being here. The floor is yours.
Thank you, Shannon. Thank you, everyone, for joining us here today. Again, my name is John Kirchner. I'm with the U.S. Chamber. We're headquartered out of Washington, D.C., obviously, but I have the joy of living here in Minnesota and doing the good work of the Chamber out here in the real world. I work closely with our state, local, and metro chambers like the Minneapolis Chamber and the St. Paul Chamber, but also with our members of Congress. And so my job is to bring what's happening in Washington out to the real world. But similarly, as I'm hearing things out here, sharing with our leaders and lawmakers out in Washington, because oftentimes what's happening in the real world isn't being heard there. But I get the great opportunity today to talk about the One Big Beautiful Bill. If you recall, going back to 2017, the Tax Cut and Jobs Act was passed under the first Trump administration, and there were a lot of great pro-growth business tax provisions in that bill. Many of them most of them, all of them contributed to a lot of growth in our economy. But what happened was most of those elements weren't made permanent, other than the corporate tax rate that was reduced, and instead were set to expire, at many of them at the end of this year, a couple of them at the end of last year. So we started a process well over a year ago, working with our elected officials, our businesses, our chamber leaders across the upper Midwest and across the country to get this new tax bill across the finish line so that businesses have certainty when they're planning. If a business owner, large, small, or otherwise, is going to be making investments in their business, they needed some tax certainty for the future, and that was our priority here. So when I look what our big three priorities were going into this process, one, preserving the competitive business tax rates by maintaining globally competitive corporate tax rate at 21%, permanently extending the small business, the 20% deduction for pass-through businesses. Secondly, we wanted to restore a pro-growth tax base. So a lot of those elements like R&D expensing, full capital expensing, interest deductibility were set to expire. We wanted to make sure those elements didn't expire so that businesses had those tools in their toolbox to grow, to hire more, to invest in their communities. And then lastly, we wanted to maintain a competitive international tax system. As we lowered our corporate tax rate back in 2017 to 21%, which kind of got us into the middle of where the world was globally, we saw a lot of other countries begin to drop their rate to get below us. So we wanted to make sure that internationally as well as domestically that we remained competitive. Next slide, please. Kind of a quick overview, what the One Big Beautiful Bill did. It extended and expanded many of the provisions from the 2017 Tax Cut and Jobs Act. It was focused on individual tax relief, business incentives, and simplifying the tax process. And one of the ways of paying for it is it did repeal many of the clean energy tax credits that were on the books, so to speak. And we estimate that it's going to be about $5 trillion in tax cuts over 10 years. Next slide, please. On the individual side, the tax rates from the Tax Cut and Jobs Act were made permanent at 10, 12, 22, 24, 32, 35, and 37%. The standard deduction increased up to $15,750 for someone who's single, $31,500 for married, and it also expanded the child tax credit to $2,200 per child. And this is important because we were very much focused on the business pro-growth tax elements, but there were a lot of important individual and family components to this bill as well, which is good not just for the business community, but for all of us as taxpayers as a whole. Next slide, please. One of the other elements that was one of the big sticking points, if you'll recall, is the SALT deduction, the state and local tax deduction. And that's something that's really important to states like New York, New Jersey, California, high tax states where they can deduct their state and local taxes from their federal taxes. Well, a lot of those blue state Republicans were holding out on this bill to get enough votes because their SALT deduction expansion was expiring. And so they went to battle on the SALT. They raised the cap to 40,000. It wasn't just the Republicans, Democrats. I mean, Republicans only voted for it, but it wasn't just Republicans that were interested in the SALT component. But raised the cap to $40,000. Phase down begins with a $500,000 adjusted gross income. And then in 2030, it's going to revert back down to the $10,000 cap where it was ahead of time. Next slide, please. On the individual side, two big elements on this was a no tax on tips deduction up to $25,000, phased out at a gross income of $150,000, and no tax on overtime as well, up to $12,500 for single, $25,000 for joint. And what's interesting about this is a lot of economists will look at this and say, well, that's not really a pro-growth element. But what we've found, we're holding about 100 roundtables with members of Congress about this bill around the country. And we're finding that a lot of business owners are coming to these events and saying, what's interesting is that I've had a lot of employees, or they've had a lot of employees that are now wanting to work more overtime because they realize they're going to be able to bring more money home from their paycheck. So while it's maybe not as big of a growth factor as some of the elements I'm talking about, we're seeing businesses also benefiting from this because they've got employees wanting to work more overtime. Whether you're tipped or not tipped, it's really important there for them. Next slide, please. On the pass-through corporate rate, the 20% pass-through deduction that was set to expire was made permanent, which was really important. And then we were also able to retain the 21% corporate tax rate, leaving that where it was. And one of the concerns were, as Congress was debating this bill early on and looking for pay-fors, there were some in Washington that were saying, well, what if we bump the corporate tax rate up to 22 or 23 or 24%? To help as a pay-for? Well, then what that ultimately does is it removes a significant amount of capital from the marketplace that could be used to reinvest in their business. So we were very happy that while that remained unchanged, while a lot of other elements were set to expire, we were able to keep many elements, but also maintain this and avoid Congress from playing with the corporate tax rate. Next slide, please. Some of the business tax incentives that I mentioned earlier, and the nice thing is we've got Adam on from Baker Tilly, so he can actually tell you how all of these work. But what we've got here today, the three big elements, we've got bonus depreciation, so 100% expensing reinstated for full qualified property, full expensing for production-related real property, and R&D expensing. So it repeals the amortization requirement for domestic R&D. So these are a lot of really good pro-growth elements for, sorry, my mailman was here today, for businesses. And again, like when I say these are elements when businesses are looking to expand and looking to reinvest and to grow, these are tools in their toolbox that they need, but they needed certainty on this. A lot of businesses were sitting on capital this year because they didn't know what were going to happen with these tax incentives at the end of the year, and they weren't comfortable using a lot of it to reinvest. Now they've got that certainty, and as they look into 2026 and beyond, they have these important pro-growth tax incentives to help them reinvest in their company. Next slide, please. Another family element in this that is business related is the enhancement of the employer-provided child care credit. And when I travel around the upper Midwest and I talk to business leaders and I talk to chambers of commerce, one of the most, if not the most important issue going on in their community is childcare. A lack of childcare, affordability of childcare, access to it. And this was a smart thing that Congress added to that bill. And what this does is it permanently increases the employer-provided child care credit. And it created a separate credit amount for qualified small businesses and indexed the maximum credit amounts for inflation. So it's not just for big companies, but tools for small businesses as well. And what it did, which is really significant, is it increased the maximum credit from $150,000 to $500,000, and the percentage of qualified care expenses recovered from 25% to 40%. So a significant increase for businesses to be able to provide more childcare opportunities for their employees. And it further strengthened the credit for small businesses by increasing the maximum credit to $600,000 and the percent of qualified child care expenses covered to 50%. So another good tool for businesses to reinvest in their employees to provide quality child care, a tool for them to attract new employees potentially to come want to work for their business as we all face workforce challenges. So this is an important element both for businesses and for families. Next slide, please. Quick checklist, if you will. If you're a small business, there's a QR code. You can go in here. I'm sure Adam's going to have a lot of good information here, but kind of 5 quick things to look at. I'm not going to go through all of them in the interest of time, but this is a good tool as you're looking to break this down. How does this affect your business as a small business? Here are 5 things that you should really look at to maximize the benefits of the One Big Beautiful Bill for your business. Next slide. When we look at the fiscal and economic impact, like I mentioned earlier, about $5 trillion in tax cuts over 10 years, and we anticipate this will add about 1.2% to our GDP growth in order of growing our economy, making our businesses more successful. They're able to reinvest in their employees through wages, benefits. They're able to reinvest, and we're going to hear later from Marie about nonprofits. They're going to be able to invest in their communities, and a lot of nonprofits doing work there as well. And so this is important for growing our overall economy, not just here in Minnesota, but across the country. Next slide, which I think is my last slide. Oh, I got 2 slides left. There's been a lot of talk, less recently with the shutdown and some of the other chaos going on in Washington, but there's been a lot of criticism of the One Big Beautiful Bill in the media from opponents of the bill, both in Washington and across the country. So what we did is we surveyed people across America to get their thoughts, if they knew what was in the bill, what their thoughts would be. And we saw that 7 in 10 said they'd be more likely to support a candidate for Congress who's preserving tax relief for individuals, families, and continuing to grow the economy. 2/3 support permanently extending key pro-growth tax provisions from the 2017 Tax Cut and Jobs Act, and if they were going to expire, it would have triggered one of the largest automatic tax increases in American history. 62% support permanently allowing businesses to fully expense investments in machinery, equipment, and technology. 67% favor permanently restoring deduction for R&D that I talked about earlier, and 64% of voters support permanently restoring the less restrictive deduction for business interest expenses. So when we are able to talk to voters about what's in this bill and explain about what's really in this bill and not just watch cable news or social media to get our news, when we can talk directly to voters about what's in this, they really support the components. And it's our job as a Chamber of Commerce, it's our job as a business community to share these facts with our constituencies, whether they be a voting constituency or employee constituency, whatever it might be, because when people learn what's in the bill, they realize there's a lot of good things in here, not just for businesses, but for them individually as well. And then lastly, my last slide, quick summary and outlook. Again, major tax release for individuals and businesses. It incentivizes investment and work. And then the one thing we're going to determine as this, we had an election a couple nights ago, and we're going to determine moving forward, what are the political implications remaining, and how is that going to be debated, and who's going to win that debate will be really important. And we as a business community, I think, have an important role in talking about the really good things that are in this bill. It wasn't a perfect bill. There is no such thing as a perfect bill, even though it's called the One Big Beautiful Bill. It is big, it is beautiful, but it is imperfect. But that doesn't mean there aren't a lot of good things in here that we should be promoting, but also as business leaders should be utilizing as tools to help reinvest in your company, grow your company, and expand your reach. And that's it for me. I'll hand it off to Adam.
Thanks so much for setting the stage with that national perspective, John. Okay, so Adam leads Baker Tilly's private wealth practice and brings more than 20 years of experience working with privately held companies, high net worth individuals, of which I am not one, and trusts. His experience in tax planning, mergers and acquisitions, and business succession offers a strong lens on how this legislation impacts financial strategy. Adam, take it away.
Yeah, thank you, Shannon. Thank you, John, for that background. Very helpful to hear some of the why, some of the context behind more of the technicalities around the Big Beautiful Bill. I saw your slide with the stat of 67% of voters were in favor of reducing the research and experiment. Tax laws. Had you surveyed CPAs, if not only for simplifying taxes, simplifying client situations, I think you would have found all those CPAs would have voted in favor of that and been at 100%. That is, over the last 3-4 years, been a very challenging area of tax to work with clients on, explain to, taxpayers. And of course, it was, a negative tax impact, delaying some deductions. But, the Big Beautiful Bill did clean up some of those, more headache type items that had existed under the TCJA. And with that, Jenna, would you jump to the next slide, please? Here today to talk about two areas. One, business related provisions in the big beautiful bill, an individual, and we can go to the next slide and I'll jump right in. John mentioned some updates to depreciation and bonus depreciation, as well as Section 179 depreciation. So a lot of words on this slide, but I think the takeaway is both bonus depreciation, which is, 168K if we're going to talk code sections, as well as Section 179 expensing on business property, both of the major depreciation areas of the law were impacted, and both favorably. Okay, we can jump on to the next slide, Jenna, if you don't mind. So let's talk about bonus depreciation. In the past, bonus depreciation had been at 100%, whereby taxpayers could deduct in year one of acquisition the full cost of that property. That percentage under the Tax Cuts Job Act was phasing down and reducing over the years, down at 80%, 60%, 40%. Well, we are now back up to 100% for assets acquired after January 20th of 2025. 2025 acquisitions early January are going to be subject to that 40%. So, really work with your accountants, work with your advisors to help, analyze that placed in service date for early 2025. In tax planning, we're always working with our clients to say, do you want to actually accelerate deductions or defer deductions? And this might be an instance where, given, placed in service dates, you may argue you want to try and fall on the front end of that date or on the back end of that date, depending on your circumstances and situation. So just a date to be aware of with regards to bonus depreciation and full expensing. Jenna, next slide, please. All right, 179 expense is kind of the old historical pre-bonus depreciation way to write off fixed assets all in year one. Those dollar amounts really were supercharged, in my opinion, under the big beautiful bill, moving up from the ability to deduct $1.22 million of fixed assets acquired in 2024 all in 1 year up to $2.5 million in 2025 and beyond. This provision is, subject to some dollar phase outs based upon the amount of acquisitions. So very much a more small to medium sized business provision, whereby bonus depreciation is available, for all taxpayers. I would say, and want to call out both on bonus depreciation and 179 expense. Take a look at that last bullet point. A lot of states have different and differing provisions from these two expensing provisions because they need to balance their own budgets. So, what may seem like a slam dunk to utilize bonus depreciation and or 179 for federal purposes, there actually might be a secondary layer of state tax impact. So please reach out and work with your own CPA, your own advisors to understand, which of these two provisions is better, given that they are both supercharged. All right, let's go to the next slide, please, Jenna. All right, enough about depreciation deductions. Let's talk about, business interest expense deductions. So we had a new concept created under the TCJA, whereby certain businesses had a cap on the amount of interest expense deduction that they could take in a given year. And that was based originally on EBITDA, okay? Then in 2022, they really removed depreciation and amortization from this, computation in a detrimental way, thereby reducing kind of the floor or the base we looked at for the allowance of interest expense, and that became higher. Therefore, we couldn't take as much interest expense. So what the big beautiful bill did was permanently go back to the original rules, whereby EBITDA is a standard, therefore allowing more interest expense to be deductible for taxpayers in 2025 and beyond. So if you were a business that had or were subject to these limitations, please reach out to your, accounting team, to your CPA to talk about, 2025 and how maybe some of that suspended interest expense is going to be freeing up, and or planning around the ability to deduct more interest expense and the dominoes of what does that mean for taxable income, for tax payments, for cash flow, etc. So tying in with John's commentary about, being pro growth, presumably this 163J tweak or reinstatement is very pro growth, given the ability to, generate a higher deduction for interest expense that's already incurred. Jenna, next slide, please. All right, John also touched on this, but the QBI deduction, 199 Cap A qualified business income deduction for pass-through entities became permanent. And this was something that, had it not become permanent, would have been a large shift in the realm and world of pass-through, i.e. partnership, LLC, and S-Corp taxation that would have hit many of my clients, many of Baker Tilly's clients, and many taxpayers out there. So just, please note that this was another pro-business, pro-growth provision that was made permanent. And so, just, again, work with your CPA to understand maybe if they were already planning for this to expire, how they might, tweak or change any recommended tax payments, for the remainder of 2025. We can jump to the next slide, please. Jenna, all right, the section 174 research and experimental or R&D expenditures that John mentioned in his survey and I had spoken to at the start. This was an area that was a revenue raiser back when the TCJA was approved, was rolled out, and basically companies that had large research R&D expenditures during the year were not able to deduct that in year one. They were more or less required to capitalize that and deduct that over 5 years. Well, here we are today under the big beautiful bill, and that deduction deferral or deduction delay has been removed only for domestic research expenditures. So if there's companies that have foreign research expenditures, those are still going to be subject to capitalization and amortization. So this is an area that, again, caused a lot of consternation, a lot of headache over the last 4 or 5 years for clients in understanding what type of an expenditure needed to be capitalized, required a lot of time and energy to sift through. So I think this one, in addition to being favorable on the tax savings front, is also very favorable to everyone more on a time and energy savings front as well. All right, let's go to the second page of this deck, and just wanting to talk about prior years R&D expenses that were capitalized and now they're being amortized. And what happens with those? Well, as you can see right in the middle of the page, taxpayers can look to deduct those unamortized costs over 1 or 2 years. So potentially 2025 or 25, 26. This is an area that there has been a lot of guidance coming out from the IRS on. As you can see in the last bullet point, there's this revenue procedure from the IRS that touches on and hits on, how to claim the deductions related to that previously capitalized R&D expense, and something that there's really no blanket answer. Every taxpayer, every business that had been previously not deducting these expenses needs to work with their advisors on figuring out how, when they're going to release those expenses. Some planning areas too. Do you, again, want to release that on year one, or would you actually look to release that in future years, given your tax profile? All right, we can jump to the next slide, please. All right, 1202 stock. John, also mentioned some enhanced provisions around 1202 stock. For those who are unfamiliar with 1202, this is the qualified small business stock exclusion, whereby high level upon creation of business, a new C corporation can qualify to be a QSBS. And when that company is sold, there's a gain exclusion. That gain on that company is tax-free. And so the holding periods were, shortened. The dollar amounts were increased that are, potentially tax-free. They gave us some guidance around, married individuals filing separately and how you can potentially double up or not on these exclusions. This is a very technical area. It's fairly simple, but it's very technical. And, if or as you maybe have investments in 1202 stock or are looking to make investments in new companies or starting a 1202 company, this is definitely an area that you need to be working concurrently with advisors. I know we have at Baker Tilly multiple team members that practice deeply in this area, and I'm continually having them on calls with my clients to help guide structuring and setting up of new 1202 businesses to make sure they're taking advantage of these very favorable or more favorable provisions around gain exclusion. All right, let's jump to the next slide if we could, please. All right, well, everyone, on this call may not be a business owner. Everyone may not be a part of, a not-for-profit organization, but presumably and hopefully, everyone on this call is filing their own individual income tax return, paying their own taxes. So just want to hit on some more individual trust and estate provisions in the big, beautiful bill. And with that, Jenna, next slide, please. All right. The biggest thing that was hanging out there for CPAs and attorneys was the uncertainty around what was going to happen with the estate tax exemption that was supercharged under the TCJA. And, was that going to get repealed from roughly, we'll call it 14 million back to 7 million overnight on 12/31 of 25? Well, we made it through the end and discovered or found out or were told that now we have a permanent $15 million, and this is indexed for inflation, estate tax exclusion per individual taxpayer for 2026 and beyond. So state tax was not repealed, but the provisions for a heightened, enhanced lifetime exclusion, were made more permanent here. And as you can see, permanent is in quotations there because this is a hotly contested topic, as I'm sure John could probably opine more on of, what might get extended even further, what might get, unwound. And so this is going to be, in my opinion, a constantly changing area of tax that just, if it is applicable to you or maybe clients or people you work with, continually keeping up to speed on this. All right. Let's go to the next slide, please. All right, some changes that kind of impact some of the higher tax bracket taxpayers. We used to have a 3% reduction to itemized deductions, pre-TCJA. TCJA got rid of that 3% kind of floor. But now, starting in 2026, we have a new modification to itemized deductions for those taxpayers that are in the highest tax bracket. So we're talking in the, roughly, and I have my notes here, $700,000 range for taxable income, I believe, is when you hit that 37% bracket. You're going to now, though, only get a deduction for those itemized deductions equal to 35%. So there's a 2%, tax benefit reduction. Okay. So just something to be aware of for higher wage earners with regards to their itemized deductions in 2026. Maybe there's a need or a want or a desire to accelerate a charitable contribution into 2025 that maybe you were, or people were looking to make early in 2026, just given this haircut. We'll go to the next slide. All right. There's also a new charitable deduction floor. As you can see, there's a 0.5% floor for charitables in 2026. For somebody making $10 million, that floor is $50,000. So charitables are only deductible to the extent, they're in excess of that $50,000 floor. If we move that to a $500,000 AGI, we're at $2,500. So just something to be aware of again in what we're working with our clients on, or accelerating those charitables into 25 potentially. All right, next slide. John mentioned also the SALT cap deduction. Really, I would say for anyone on this call or anyone advising clients or working with people that have AGI between 500,000 and 600,000, the SALT cap starts phasing down from the 40,000 to $10,000. And so anyone you're working with or are in this situation, there's a need, a want, a desire between now and year end to kind of watch and monitor that and plan around, that phase out, as it could be a meaningful dollar amount to some people. So, all right, let's go to the next slide if we could. So just finally, some other TCJA changes that were made permanent by the big beautiful bill, some casualty loss rules. So miscellaneous 2% deductions, i.e. attorney fees, tax prep fees, other unreimbursed business expenses that people used to be able to deduct are still non-deductible. However, for educators, there's a carve out call out for some educator expenses. So if we have any teachers, on this call, or people that know teachers, please let them know in 2026 and beyond about a little bit of an enhanced deduction for teachers on educator expenses. And then the home mortgage interest deduction limitation was, made permanent at that $750,000 level, where it had used to or previously was at $1 million. So just some other items that the big beautiful bill did make permanent that, people are historically aware of or historically had to deal with, but now, those exclusions and or change limitations are permanent. So with that, I think I am at the end of my slides, and Shannon, I'll turn it over to you to go to Marie.
Excellent. Thanks, Adam. That was really helpful for what this looks like for tax planning, even though I will admit, we start talking about taxes and I get completely lost. So I'll have follow-up questions for
you. At least you were still awake and came back on the screen. So.
All right. So before we do move to our final speaker, we want a quick reminder for the audience. If you have a question, drop it into the chat. We do have a couple of questions that were submitted ahead of time, and then we're going to try and do those and the Q&A segment in just a few minutes. So our final panelist, Marie Ellis. Marie serves as the Senior Advisor for Policy and Impact at the Minnesota Council of Nonprofits, where she helps guide MCN's public policy efforts to strengthen the nonprofit sector across the state. She brings deep experience in policy analysis and advocacy on behalf of Minnesota's nonprofit community. Marie, good to see you.
Good to see you too, Shannon. Thank you.
Take it away.
All right, I will. Well, thank you for the introduction, Shannon. As she mentioned, I've got about 2 decades of experience working in nonprofit advocacy, including as Director of Government Affairs at the St. Paul Area Chamber. That was about 8 years ago. I was there for a couple of years. I got to hire Shannon, so you're welcome, everybody, for that. I did have to leave that role because of some family health issues, but I'm really grateful for my time at the St. Paul Area Chamber. I got to know many of you. It's really fun seeing all the names on this event. And I got to really understand more about the challenges that businesses face, more than even just Skyway issues, which I'm sure are still hot button. If you're not familiar with the Minnesota Council of Nonprofits, we have over 2,200 members all across the state. We are actually the largest state association in the country. We're pretty proud of that. And our analogy will work really well for this crowd when we say we are like a chamber of commerce for nonprofits. You all know what that means. We host conferences and trainings. Our last conference had 1,300 people in St. Paul, and we conduct research on the sector. We advocate for the sector at all levels of government, and that's really where my work comes in. Next slide. One of the things that I learned when I worked at the St. Paul Area Chamber of Commerce is that when you work at a membership organization, every position is a sales position. So I would be remiss if I didn't mention that MCN has associate memberships for our for-profit partners. I took a little screenshot of some of the benefits of membership on the screen there, but you can visit our website for more information. Next slide. I'm going to set the stage by briefly talking about the state of the nonprofit sector, kind of without even thinking about the One Big Beautiful Bill Act. There are about 10,000 nonprofit employers in Minnesota, so many more nonprofits, but about 10,000 that have at least one paid employee. And nonprofit employees are 13% of our state's workforce. It's also important to note that most nonprofits are very small. About 71%, so almost 3/4, have annual revenue of under 1 million. Next slide. I keep forgetting that I have to advance my own slides. Okay, the next information I have is from our current conditions survey from 2025. So next slide. This graph shows demand for services. So the question that we ask in the survey is, in the last 12 months, has your organization seen an increase in demand for your services? Now, that first data point there is December 2020. That's obviously during COVID time. About 40% of nonprofits reported increasing demand for their services over the last 12 months. I assumed incorrectly that number would decrease as the pandemic lifted. But as you can see in 2025, this year, 70% of nonprofits reported an increased demand for their services. So the increase in the increase is important as well. But basically just know that demand for services of nonprofits is increasing. And at the same time, it won't surprise any of you to know that expenses are also increasing. This is something we share with our for-profit partners. Over 80% of nonprofits reported an increase in their expenses in 2025. That's up from 35% in 2020. At the same time that we have those issues going on, foundation grants and corporate giving, along with individual giving, is also going down. So state of the sector it's rough out there. Next slide. My last sort of setting the stage slide is about general threats to nonprofits that we're seeing right now. So like I said, increased demand for services, increased expenses, decreases in funding, which will get worse under the One Big Beautiful Bill Act. And then we've got these issues as well, which are just kind of causing a whole swirl of epic uncertainty and concern about funding, about operations, about what's legal. I think a lot of our business friends are feeling the same way. You might recall that in the first few days of his presidency, President Trump attempted to freeze all federal funding. I mean, for nonprofits who partner with the federal government through contracts, it's like a 5-alarm fire. I mean, it was a huge deal. And that was just one of these executive orders. So nonprofits are dealing with a lot of different legal issues as well, and a lot of questions around what they can and can't do. Next slide. All right. There are some pretty big picture concerns that the Council of Nonprofits has with the bill. There's a pretty significant redistribution of wealth to the already wealthy. But for the purpose of this presentation, I'll be focusing on specific impacts to the nonprofit sector. I think we're not here to debate the merits of the bill so much as present information. Although I will say, if you're interested in a bit of a different perspective on Adam's thoughts about how the bill is good for families, I ask which families and encourage you to look at the Minnesota Budget Project's website. They have a blog up from Halloween, actually, that talks about some of the impacts of the bill on families. So take a look at that if you're wondering for more. So I'm speaking to impacts on nonprofits as organizations, but of course, what's ultimately important is the impacts on the communities that are supported by the nonprofits. I just want to make sure we're clear that that's always the ultimate important thing. Okay, stage is set. I'm talking very fast. Getting to the heart of the content, let's look at what the One Big Beautiful Bill Act, what's in it and how it will impact the nonprofit sector. Next slide. We'll start with funding. Funding, of course, critical. Can't do much without any money. There are multiple pieces of the bill that are going to decrease funding for the sector overall. I will note it is very difficult to predict how, when, where, and how much a donor gives and how much tax incentives factor into those decisions, right? We just heard about, maybe it's smart to accelerate giving in 2025 because there are better tax incentives. It's hard to know how many people will do that. Just really don't know. But we do have some data from previous changes to tax law and tax incentives. And based on that data, we are unfortunately quite confident that these changes will result overall in less funding to nonprofits across the country. I'll add that funding from individual donors is often the most valuable funding that a nonprofit has because it's not restricted. A lot of foundation grants and government contracts are very restricted in what they can be used for. So that individual giving is like it's gold. It's got more value than other things. So first, I'm really going to focus on the top two here. And we talked about these a little bit, but I'm kind of looking at it from a slightly different perspective. So the bill has smaller tax incentives for charitable giving for taxpayers who itemize. That's about 10% of taxpayers, about the 10% wealthiest income earners. And they won't get a tax break on that first 0.5% of their charitable contributions once this takes effect. If you have questions on that, we're going to ask the CPA, which is great. I love that you're here because that means I don't have to answer those specific questions. There will be a floor on charitable contributions from corporations. So this is not foundations, right? But from the actual corporation. And those incentives, so the charitable contribution will only be tax deductible when it exceeds 1% of a corporation's taxable income. I'm not going to focus a ton on the third and fourth ones there. And actually, I made these slides a few weeks ago, and I'm not quite sure why I didn't include a bunch of the other things. So I'm just going to put something in the chat there to the Minnesota Council, to the Council on Foundations federally. They've got some more specifics on some giving changes. Okay, let's see. Next slide. Now, continuing on funding, there is one bright spot in the bill related to charitable giving, which is that it establishes a universal deduction, also sometimes known as a non-itemizer deduction. So under current law, as you've heard from multiple of us, only taxpayers who itemize their deductions, and again, that's about top 10% income earners in the country, can receive a federal tax incentive for charitable giving. So there's no tax incentive for charitable giving for the 90% of taxpayers who use the standard deduction. This legislation will create an above-the-line tax deduction for contributions from those 90% of taxpayers who take the standard deduction. It's modest. The limit is set at $1,000 for individuals and $2,000 for married couples, but it is a meaningful shift towards a more equitable tax system, one that recognizes the importance of generosity of all taxpayers, not just those with the highest incomes who can donate the highest amounts. This is something that my organization has worked for a long time, and it's something that we helped to institute in Minnesota. So if you were thinking, she's wrong, I know I have taken the standard deduction and itemized my charitable contributions. Yes, you did that at the state level. Thank you. Now you'll be able to do that at the federal level as well. Unfortunately, they're not the same tax incentive structure, so that might get a bit confusing, but it's just, job security for our CPA friends, so that's great. Next slide. This was hard for me to figure out how to put this on a slide because it's a really big deal and I don't have any details. Nope, there are no details. So HR 1, One Big Beautiful Bill Act, it shifts a lot of costs and responsibilities to the states. And it's going to be impossible for states and local governments to totally fill in those gaps. So at this point, we don't have specifics on what that looks like because we have to wait for the legislature and the governor to make decisions. So the state is tracking cuts and disruptions in federal funding. You can go on Minnesota Management and Budget's website, and they've got that. I think I put the link there at the bottom. But those numbers, the cuts to funds to the state from the federal government, are going to increase dramatically as various provisions of the One Beautiful Bill Act are put into effect. It's also really important to remember that the federal government may cut funding that's meant for a specific program that the state runs. That doesn't mean the state must cut that program. That means if the state wants to continue that program, they need to find revenue elsewhere. So we can't just assume, oh, federal government's cutting it. Well, guess it doesn't exist anymore. And so if there are things like that, it's important that we're talking with legislators and the governor about what we think are the most important things to cut or not cut, hopefully. So like I say, I wish I had specifics for you, but I don't. Next slide. Okay, I saved the biggest for last. And again, as I was reviewing these this morning, I thought, why did I put all three of these on one slide? These should be 3 separate slides. So who knows what I was thinking, but anyhow. All right, so we looked at impacts on funding for nonprofits. Let's shift to impacts on demand for nonprofit services. Like I said, that has been going up for the past few years anyway. We're expecting to see immediate surges in demand from nonprofits for services, especially in food shelves and health clinics when these policies are implemented. They make extreme cuts to Medicaid and SNAP. I'm not using the term extreme lightly. So let's start with looking at Medicaid. In Minnesota, we call that medical assistance, or MA. 1 in 4 Minnesotans gets their healthcare through medical assistance. The bill will change eligibility requirements. It will cut benefits, and people will absolutely lose access to their healthcare. But of course, we're people and our bodies need healthcare, right? I wish I was one of those people who didn't, but I don't think they exist. So when people need to care for their body, they will need to go to free clinics. And those clinics, those free health clinics, are already dealing with all the issues we've talked about funding and already seeing increased demand. Then if we look at SNAP, SNAP has been in the news a lot this week because of how the federal shutdown is impacting SNAP. But that doesn't have anything to do, it's a separate issue than how SNAP will be impacted by HR 1, by the One Beautiful Bill Act. The bill will dramatically cut SNAP benefits. So what we're hearing now about folks losing their SNAP benefits, hopefully when the government reopens, that will, things will go back to the way they were, but not for very long, because then there will be these extreme cuts to SNAP as well. And so if folks don't have money to go to the grocery store, where are they going? They're going to their local nonprofit food shelf. And again, they're already stretched thin because of inflation and COVID and all those things. An interesting fact that I saw earlier this week is that 12% of grocery revenue, this is from the National Grocers Association, comes from SNAP funds. Interesting business factoid for you. On to the next point there. We're expecting to see nonprofits struggling to find enough staff to meet some of those rising needs and demand for services, even if they have the funding for staff. And this will be due to mass deportation and detention programs, particularly in certain communities that are impacted more highly from those detention programs. I think that's a concern we share with for-profits as well. And then the final one on that slide, I think you all know many small business owners and staff find healthcare coverage through Minnesota's insurance exchange program, MNsure. Same is true for many small nonprofit employees. The current government shutdown reportedly is due to Democrats refusing to sign off on any legislation that doesn't extend the premium tax credits for people who use MNsure. If those credits are lost, it will significantly raise the cost of healthcare coverage for about 89,000 Minnesotans. And I just saw the number this morning. The average premium increase per month for an individual would be $177 across the state per month would be the increase if those premium tax credits are not extended. So we'll see what they decide to do about that. But we're concerned that these increased costs will put pressure on staff at those smaller organizations to find new employment where they'd have different healthcare coverage. And it'll also just overall increase demand for nonprofit services because it's fewer dollars that people can keep for the things they need, like food. Next slide. So what are we up to now? What's next? We're bracing for these impacts. And as a coalition, as a council, we're doing our best to convey to nonprofits that they need to be advocating with and for their communities and their clients, and that they really have a responsibility to share information with decision makers, especially if their decision makers, their elected officials, aren't getting that information elsewhere. If you are on a board of directors, first of all, thank you. We literally can't do our work without you. Please take a minute and talk to the organization about their advocacy plans. You can remind them, if they don't currently do any advocacy, that nonprofits absolutely can advocate, and we can lobby with some limits, of course, and reporting requirements. And just remind them that they shouldn't assume that elected officials understand what's happening in their communities. Next slide. So to sum up, I took this from a different presentation that one of my colleagues did. One Big Beautiful Bill Act will lower resources for nonprofits while driving up demand for services, which will negatively impact communities across the state. Last slide. That's it for me. Thank you.
Thank you, Marie. That was a good overview. Okay, we have a few minutes left and we have moved into our Q&A. So let's see, I've got a couple of questions that were pre-submitted, but I think some of those have been have been answered within the presentations. There is a question in the chat about national debt and how business interests should approach national debt. I'm not quite sure. Luckily, I am not a panelist. I am a moderator. So I will put this to, and I think I'm going to start with John first. And then if Adam or Marie have something to add, chime right in.
Yes, happy to answer the question, or at least attempt to answer the question, Shannon. Part of the challenge with scoring of these bills, if you take some of these tax incentives, it counts against, so it counts as a cost to the bill, but it doesn't take into account the additional revenue that's coming in. And we saw, as a result of the Tax Cut and Jobs Act, federal revenue increased in that time period. I would contend that, separate from the One Big Beautiful Bill or tax policy, our federal debt and deficit isn't a revenue issue, it's a spending issue. I think 85% of the money the government spends. So if you say we want a strong national defense, we don't want to kick grandma off Social Security, we want to keep Medicare, Medicaid, all those entitlements, 85% of the money the government spends goes out the day before Congress ever takes a vote on spending money, right? And so by way of contrast, in 2019, our federal spending was about $4.4 trillion. In 2025, it's expected to be over $7 trillion. Adam can probably do the math for me, but I think that's about a 60% increase in federal spending. A lot of that is going directly to these entitlement programs and defense and other non-discretionary items like that. And so I'd contend that debt and deficit isn't related to tax policy as much as it is related to spending policy. And even when the new administration came in and Elon Musk was doing Doge and all this and all the savings they were finding, it's couch cushion change, right? In terms of limiting the debt and deficit and reducing the debt and deficit. And the only way to do that is for Congress to have really difficult conversations and all be willing to commit political suicide by getting voted out of office by, I don't know if you have to raise the retirement age or change benefits or whatever it is. I don't have the solution, but our debt and deficit is directly tied to spending largely on entitlement programs and defense spending and things of that nature, not on everyday discretionary spending. And so as a business community, I think it's our job to talk to our legislators and our elected officials and let them know that the debt and deficit is a real threat to our country, to our economy, to our international security, and they need to have the hard conversations to address the core elements of what's driving the debt and deficit. And I would argue it's more of a spending policy than it is a tax policy.
Marie or Adam, anything to add?
No, definitely not.
Okay, awesome. I did want to point out, like, one difference between the federal government and the state government that makes this sort of weird is that at state level, we have to balance our budget. And at the federal level, we get to print money. So, yeah. Okay, we're going to go to this question. What's one misconception you've already seen about what this bill actually does, and how do you educate your constituents?
I don't know that I've seen any quote unquote misconceptions. In our space and serving and working with our clients, it in some areas kept the status quo, i.e. maybe simplified, items for people, but in other spaces, as I mentioned, as I talked, created some changes and some complexities that people just need to be aware of. But from an overarching misconception standpoint, I'm not sure, at least from the CPA lens, that there were a lot of misconceptions out there.
I think one of the misconceptions that I'm seeing, and this is largely because I get to work with the wonderful people at the Minnesota Budget Project, and I alluded to this before, is that this bill will be helpful for families and lower income folks. It won't be. It will be extremely detrimental to those populations. And that's it.
Yeah, I would circle back on that. And I guess my misconception, and maybe it's a little bit different from Marie's, but where this got pivoted to being from one side. I mean, this has become a political exercise, not a tax and policy exercise anymore, which kind of everything in Washington is, unfortunately. But you know, the big misnomer to me was that this was just tax cuts for the rich. And there's a lot of small businesses that are taking advantage of this 20% pass-through deduction that are by no means rich and wealthy, but that are running small businesses. Or there's a lot of businesses, big, small, and medium, that are taking advantage of these tools that are given to them to grow and expand their business, which will allow them to pay employees more money, to offer new benefits, hopefully, Marie, to reinvest in their nonprofit community, in their community or across the state. And so I think that's the misconception, that this is just about the rich and the wealthy, when the 20% tax through deduction is specifically for small businesses that might be someone owning a coffee shop or someone owning a small manufacturing facility that are not rich and are not wealthy, and will see, and their employees will see, tremendous benefits from this in the long term.
Okay, well, I'm noticing the little alarm in the corner of my screen is going off. It is 1:59. So unfortunately, we have to cut off the questions for today. So thank you to everyone who participated. A special thank you to our panelists for sharing their experience and insights. As a reminder, today's session has been recorded. It will be distributed to all registrants, but we're not posting it out on the world. But we do encourage you to share it with colleagues who might find it helpful. Thank you for joining us today, and have a great afternoon.
Thank you.
Everyone.